From 1st July 2026, a whole stack of financial rules change on the same day, and almost every Australian is touched by at least one of them. There are tax cuts, payday super, higher contribution caps, and new reporting rules, and most of it happens automatically, but only if you know what to do. Here is the complete rundown. The headline change is a cut to the personal income tax rate. According to the ATO, the marginal rate on income between $18,200 and $45,000 falls from 16% to 15% from the 2026-27 income year. It is legislated, so it happens whether you act or not, but it is not the only thing changing on that date. A 1 percentage point cut sounds small, but the ATO estimates it is worth about $268 a year for someone earning $45,000, and the lower rate flows through to higher incomes as well. On top of that, the Conversation reports payday super is expected to leave workers with bigger balances over time. Together, these changes quietly reshape your take-home pay and your retirement savings. This reaches a wide range of Australians. The ATO puts the tax saving at about $268 a year for a $45,000 earner. The concessional super cap rises to $32,500, and around 80,000 people with balances above $3 million face an extra tax on those earnings. So whether you are a regular wage earner or a high balance saver, something here applies to you. Here is the sharpest number to remember. From July 2026, earnings on the part of your total super balance above $3 million are taxed an additional 15%, according to the Conversation, with the ATO calculating the liability. For balances above $10 million, a further charge pushes the effective tax to around 40%. Here is the catch buried in all of this. The tax cut is automatic, but if your payroll withholding is not updated, you can end up overpaying and effectively lending the ATO money interest-free until you lodge. And retirees who ignore the reset SAPTO thresholds, now cutting out at $53,174 for singles per the ATO, can leave hundreds of dollars of offset on the table. So here is what to do now. Log into MyGov and the ATO to check your 2026-27 income estimate and which bracket you land in, then make sure your PAYG withholding matches. Review your super contributions against the new $32,500 concessional cap and decide if extra salary sacrifice makes sense. And if you run a business, check AUSTRAC online because more industries are caught under AML CTF reporting from this date. Mark the date, because it all happens together. Payday super, the tax cuts, the indexed contribution caps, and AUSTRAC's new reporting forms all go live on 1st July 2026 per the ATO and AUSTRAC. There is no staggered rollout. It is one busy morning. This is not a one-off. The ATO confirms the same bracket rate falls again to 14% from 1 July 2027, so there is a second tax cut already locked in. And AUSTRAC says existing reporting businesses have until 30 March 2029 to fully move to the new forms, so compliance work runs for years. Keep your planning under review each budget. That is the complete 1 July 2026 rundown. Tax cuts, payday super, higher caps, and tighter reporting, all in one day. Subscribe to the fine print, and we will keep you across every change as it takes effect and break down exactly what each one means for your money. Remember, this is general information only and not financial advice.